how we get the deal actually approved.
Okay.
Okay, so let's, from a very high level, let's hit on the 2 or 3 main points that banks are looking at as like the primary things. Let's start off with with leverage.
Leverage. Yeah.
Okay. Explain to everybody what leverage is and how banks are looking at when it comes to lending on real estate.
So leverage, or how levered your business is with debt, not too dissimilar when you're looking at somebody individually, right? With sort of debt to income levels. Personally, leverage is how much debt a business can take on and sustain and still meet their minimum obligations in payments and so on and so forth. As a general rule of thumb, most banks will look at a leverage level in about the 3 to 3.5 times range. And what that means, when you talk about your true income level, EBITDA. We'll get into EBITDA in a later podcast. But when you look at your EBITDA, how much money the business is making, a multiple of that number is considered leverage. So for round numbers, let's say you make $1 million of EBITDA, you should have between 3 and 3.5 million of debt.
Well, you shouldn't have it, but you should have no more.
Than that. Yeah. Exactly. I didn't mean you have to have that much, but that's generally the upper end guardrail as to how much debt a business can take on. Now, the reason that has come into play over years, it's just based on statistical data over many, many, many decades. Because we find as a bank and an institution, once your leverage exceeds 3.5 times, what we start to see is higher failure rates.
Yeah.
And that's no different than if you were to go for a personal home mortgage and you take the absolute pinnacle, highest you are qualified for. Well, that assumes that your level of income is going to be maintained. What if there's a drop in your income level and you can't meet those payments? The same goes for a business. And most banks should be advisory in this capacity, where we have to sometimes scale the debt ask back for a company for their own benefit, because we don't want to put them in a place where they're open to failure and not being able to meet the debt payments.
So just so we're absolutely clear on this is all the debt that you have out there divided by your EBITDA. So if you have a large line of credit out there, you have some equipment financing, those things are going to all go into your
this is cumulative
leverage profile. And so when we look at your leverage profile, if you have all this other additional debt, that's going to limit your capacity to borrow for real estate.
Yeah, that's a good point. Leverage is not just on the current credit ask.
Yes.
It's everything that you're asking for and everything that you have.
Yes.
That's the debt picture. That's leverage.
So that's kind of one of the first things. That's kind of that's more of a balance sheet thing.
That's a balance sheet item. Absolutely.
Let's go to the other side of the table and let's talk about debt service coverage.
Right. So now we're talking about the income side of the house, and a general rule of thumb, and this is across all banking with a few exceptions, but we're basically looking at a 1.25 times debt service coverage. And what that means is, for every dollar of debt you've taken on, to the earlier point, all your debt, all your obligations, your automobile payments, equipment loan, your line of credit in your building, whatever you have, for all of that debt, you need to generate at least a minimum of $1.25 of profit to be able to service that debt.
Yeah. So exactly. So what Adam's saying is, if you have $1 million in debt and your payments for that particular year of debt of principal and interest is $100,000, you should have made $125,000 minimum. Mm-hmm. So if you're looking at your deal right now and you're trying to say, am I going to qualify for some debt? These are actually probably the two biggest things that the banks are looking at. So if you can say, what's my total debt going to be and how does that look from a leverage standpoint? Am I going to be under 3.5 times? And then from a debt service capacity, what will the payments be with this new debt and all my other debt? And how does my earnings, am I making 1.25 times my payments? For the most part, that's gonna get you in a ballpark where you're ready for a conversation. You're ready.